Welcome to Fidelity Soundbites, a straight-to-the-point monthly podcast where we interview some of our leading portfolio managers within Fidelity. I'm Lucas DePaulbay, Fidelity's global cross-asset specialist, and I'm pleased to be joined here by James Abela, portfolio manager for the Australian Future Leaders Fund.
Hello.
Welcome, James.
Thank you.
We're going to talk about a little bit about everything today, but let's start off with the broader markets. And if we sort of roll back and think about markets, the last sort of 10 years or so have been a very different market environment. We had very low interest rates. We had markets that were driven by central bank policy and ample liquidity.
Yeah.
Now, it seems like things are changing.
Definitely.
How are you seeing this? And is there any sort of period that, in your mind, resembles this type of period that we're experiencing at the moment?
Look, it is a very unusual time. The only time really in the last decade is after 2006-07 in terms of the market sort of psychology where it is. It got very, very fearful around the crisis in 2006-07, the slowdown of economics and the Greece crisis. And then you had this huge recovery thematic. So cyclicals really worked. And then after that, you had sort of the now period, what it is similar to now. Nothing easily worked. It was very specific. Correlation started to break down. And now you are where we are today. It's very volatile. There are very few thematics that are very easy to own. Even 6 months ago, you could own certain thematic structural and cyclical, and now they're all sort of fading. The market's run up, and now it's running back with a lot more sort of caution. Valuation discipline 6 months, a year ago was really strong. You had quality stocks being corrected, momentum stocks being corrected, and now you've got very, very stock-specific stocks. So some momentum stocks running, some quality stocks have recovered. Things like Promedicus was up 10% in the last week on an announcement of a new contract. It's on 90 times PE. WiseTech's had a recovery, but it came off, and then it's still on, 60, 70 times PE. So a lot of, it's very, very patchy. Like, there's nothing sort of easy about the market. It's very, very stock specific. And a lot of managers are really torn between being defensive or going more for growth. And being, I guess, a bit more positive and constructive. China sentiment was a big thing to get the market up again. That's also come down again, and now it's more about India and Japan. So there's a lot of movement. It's just a lot of movement. It's very volatile. Sentiment's really shifted. Every sort of week or a month, it feels like it's a different market.
Mm-hmm. And one of the things you pick up on was the sentiment. And I recall last month's podcasts where, general sort of theme generally was like, yes, there's still negatives, still headwinds, still clouds ahead. Yeah. But it felt like sentiment was
much more constructive.
It was much more constructive.
It was constructive. It was recovery. I mean, I sort of giddy up month last month, and everything that came out was kind of the market sort of saw the positive. It wanted to be positive, and now the market kind of wants to be cautious, and that's quite a big turn. And even small caps in the US was really strong for 3 or 4 months, and then now it's sort of again starting to slow down like we are here.
So when you see this sort of shift in sentiment, how do you navigate that as a portfolio manager? Because it's so fast moving at the moment. As you say, you got 1 month where we're nearly popping open the champagne bottle that yes. Inflation's done.
Yes,
we're seeing the light, and suddenly we're doom and gloom.
Yeah.
As a portfolio manager, what do you do in that environment?
Yeah, well, it's a good question. And for me, I've pretty much maximum at quality. So quality have a tactical weight of 40% with a plus or minus 10. So it can be 50 to 30%, but we're at 50% right now. But you don't want to get too, I guess, greedy almost on valuations, because you can just go for quality and say, right, it's quality market, just go for quality, because valuations are still quite disciplined. At the same time, you don't want to be, own no momentum, no thematics at all, but there are cyclical recoveries out there. There are things that are actually improving. Yep. Some economic clusters are still doing quite well. And some of the consumer names are still things that you need to probably own because they are actually growing. So for me, you just got to keep very balanced, very disciplined, really think about what you own and why you own it. But the biggest thing is you got to be very careful of valuations. When sentiment moves, valuations doesn't move much before earnings. And that's where you can get quality stocks or momentum stocks really running without the earnings being there. So just valuation discipline is definitely the top of mind thing at the moment, and that's probably one of the focuses.
And can you, just a question from me, because, you hear the word quality out there in the market quite a fair bit, and there's different sort of takes on what is quality. How do you, when you think about quality when you think about a stock and what's a quality stock, what are sort of the top 3 attributes that you're looking for?
Attributes definitely ROE, so return on equity, and then you look for ROIC, return on investor capital, so those groups. Persistency of that return, so you look through cycles, and then it's about duration, so the market structure. So they're the big 3. So ROE, how persistent is it and how long can that last for? And if that, for me, is high ROIC, so our country's average is ROE is around 10, very similar to the total market for Australia. And then if you have the persistency of that and you can maintain that over a 3 to 5 year period, and you can see that out another 3 to 5 years, that is definitely a quality stock. And that's, for me, what I think of as quality. And
one of the interesting things is that the whole concept of, the sort of animal spirits in the market. So, when there is negative news in the market, people get fearful. Your general sort of punter on the street may be, looking to sell. Conversely, when the market's doing really well, everyone gets really excited, and it's no one can see that there'll be ever downside in the future. So, from your perspective, though, those type of environments do create opportunity where you can think about counterintuitively to what's happening in the market. So, in periods of market dislocation, as we've seen, in 2008 and as we saw in other market environments, we're sort of in a bit of that type of environment at the moment. Do these type of environments create opportunities, and how do you play them out in terms of your portfolio? And what are some of the pockets of opportunities you are seeing at the moment? Yeah,
definitely. I think that's the thing. You can't be too negative and get involved in the sentiment and fear and greed, because you can really cause a lot of pain for yourself in terms of portfolio performance. The key thing is, I guess, focus on returns on capital. That's really the key. And what I do is I go back to that, and also free cash flow yields, because even value stocks and cyclical stocks, free cash flow yields can tell you it's a buying opportunity. So we are definitely still leaning towards those structural growers, so healthcare, technology, and global consumer. That's where our major overweights are. But then those sort of medium-term opportunities and the medium sort of conviction weights are in their cyclicals, and some of the defensives, so a little bit of real estate and other sort of cyclicals as well. And then there's sort of very specific, what I'd call self-help stories that you need to actually just listen to, because they're not affected by this fear and greed, sentiment shift of positives and negatives, and recovery on, recovery off. And so they're the sort of 3 groups that we basically have in the portfolio, and I see opportunities in all of them. But you need to be, I guess, spread across those 3, because if you focus on one of those 3, you can be hurt. But when you're well diversified, it's generally better outcomes.
Is there a stock in your portfolio at the moment that you sort of maybe is a little bit unloved by the market, but you're just sort of seeing through the market and saying, actually, I think this is a quality stock?
Yes.
What's a good example of
that?
Probably
Lovisa's the one that's very controversial, because it's consumer sentiment generally is very fearful. It is a very high return on capital business. It has incredible margins, incredible gross margins, incredible net margins, incredible ROIC, and has had a long history of growth. I think it's been affected by multiples lately, and a lot of consumer names have, but that's one where I think, definitely the market is a lot more negative, but long-term holders and long-term investors feel a bit more comfortable. But that's definitely one that is definitely sort of out of favour generally, but we still own it.
And just I know we've discussed this in other podcasts before, but the consumer's an interesting one in that it's a topic everyone's discussing. Everyone's sort of got a view, and is the consumer rolling over? Are they not? I guess and Lovisa's an interesting one in that. Obviously, it's not uniform across the whole sort of consumer market. So just your sort of any sort of more insights around that consumer market and what you're seeing, because it does seem like it's a bit patchy in terms of which part of the consumer market.
It's very, very patchy. So Lovisa's really sort of teenagers. That's really what the core market is. So it's not right across the board. And most things that are broader have been better. So like KFC, Collins Foods has been quite good. Temple & Webster actually delivered a good result. So online was quite good generally. So it's really only homewares and apparel have been tough as a category, but companies even within that, as I mentioned, Templar Webster have been good. So yeah, it is just very patchy. We're just really waiting, I guess, for the next 3 or 4 months to see interest rates and housing and unemployment, if that does have an impact on consumer. The country's been, Paul Taylor, our portfolio manager, he said it's been the slowest recession that's ever happened. People have been waiting for it. And you can see that in Aussie consumer and small caps. It's the same thing. People have been waiting for the slowdown. And it just hasn't really hit hard, except in those categories, which are quite, small. So that we're just waiting really, I guess, for the flow through of cost of living. We're still expecting unemployment to tick up a little bit. Inflation has been stubbornly high. So that sort of thesis of higher for longer has been what has concerned the market. And that's what we're really waiting for, the flow on impact of that higher for longer. Because the longer that you do have high inflation and higher rates, which is what's happening right now, the flow on impact of that is likely to come. So the probabilities are increasing, but the duration keeps on extending.
Sure.
So it's a very strange environment. And that's, I think, why the market is quite volatile.
Sure.
Because it's been very odd.
And do you think the market has priced all this in, though, like the recession talk, or do you think it's still sort of something that's not adequately being priced into the market?
The market's a very, very efficient discounting system. It is incredibly efficient, and I think it was very keen to price it in a few months ago. So I do think it's definitely in the investor's mind and in the market psyche right now. So I don't think there's some shock that's around the corner. That's why I think it feels like a bit of a muddle through kind of month this month. But I do think as the earnings start to come through, and if the recession doesn't happen or things are better than expected, the market will move quite quickly on that. It's just that the market psyches has definitely moved more cautious this month. But it's been very much a wait and see kind of for the reality bites to come. And that's what I think the market's still waiting for.
And in that time, if we do see that sort of the market, that may potentially that recessionary environment come in. I mean, typically, again, from a portfolio perspective, is that, you're getting set now for that sort of scenario? Or
the positions that I put on now they're defensive. Like that, we have defensives, we have structural growers. We're not going becoming what I call a valuation cheerleader, especially in quality stocks, because that can be a huge danger if you do have recession fears or the market coming off. Those very high PE stocks can come down. So you've got to be a nicely blended portfolio. Like I said, you have your structural growers, which aren't affected so much by the recession because they have pricing power, they have good market structures. And then you'll have your cyclicals where you have evidence of growth, and then you have your self-help or your internal, management ones where it's driven by something inside, not the macro. And I think you need to have a blend right across the portfolio. Otherwise, you can be very exposed in a recession fears. And the global trends are still weak in terms of China. We had our global asset allocation discussion last week, and the sentiment from Europe was quite weak, and the US is still actually quite strong, but it is weakening. But then when I look at the strategists that I look at in the global context, we had 2/3 of sectors in the US, particularly in upgrade mode, whereas Australia is like 90% still in downgrade mode, just in the last sort of 13 weeks. So the contrast is very sharp between even different countries. So I think that's why I think the sentiment is shifting quite quickly because it's so localized, and then at the country level, and then so specific at the stock level that there's no easy brush to draw. So I think you need to be very careful in the portfolio and keep that in context when you are building portfolios right now.
That's sound advice. We're probably coming to the last question at the moment, and probably one, if you think about it, we're bombarded with information. There's constant talk about inflation. There's talk about, recession, no recession, all of those sort of things. What's the one thing that you think isn't getting enough airplay that should be getting the airplay in the discussion?
I'd actually just go back to fundamentals and just look at cash flows, and cash flows are actually still okay. Free cash flow yields are there. Even returns, even the return on capital is still around 10 to 11, which is pretty normal. But the PE is not normal because of all these macro fears and concerns. And when you get high rates, PE multiples come down. That's what happens. It's mathematics. It's reality of the financial markets. So that's what I think is just focus on the fundamentals. That's why I say ROE and free cash flow yields. And you never hear those sort of discussions everywhere in the market, fees. And
they don't sell news, right?
No, they don't sell news. They're not like, wow. They're kind of just... but they're normal, like they are in normal ranges. So that's where, and that's where I focus on at the stock level and the sector level. So for me, that's what I'd say for investors to look at those things, because they're things give you a good guide of opportunity that you asked before, but also where the reality is rather than where the sentiment is.
James Abela, thank you very much.
Great, thank you.
Thanks for listening and thanks for taking the time. Please hit the subscribe button on whichever platform you're using for your podcasts. And we look forward to you listening in next month.
This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation or needs. Please note that past performance is not a reliable indicator of future performance. You should consider the product disclosure statement and target market determinations for Fidelity Australia products available at fidelity.com.au.